Welcome to TradeTheMBA.com. This is John Reporters for the 23rd, and this is the new spring. Not a big shock. We were at our 50%. We couldn't get any, and this is a funny thing because people would say, okay, that's automatically support. Well, no, it's not. Because we could clearly see there were no buyers at what is supposed to be support. That is not support. That's the antithesis of support and why we broke down. Now, we didn't start off that horribly. The day really was modest, but we had talked about this. We had a very simple criteria. We had the ABMDL green, and which was corresponding directly with the 50% line. So there it was, right at the 16. Oh, I lost my number. Let's put it back up. There we go. 16 and a quarter, and then you had the 50% at 0.8. So it was a nice 8-point spread just between the ABM green and the daily 50%. But intraday, we could clearly see where the short was taking place, and once we broke below that ABM green, I said, you got to be short or out the market if you're not comfortable being short, which I would highly recommend getting comfortable with if you're not. And, well, here we go. We went straight down. Now, when we look at the intraday chart, it wasn't all that bad straight down. There were just some very clear points. Now, we knew that we were obviously going to be attracted, obviously, to that low right there. Usually, if you're going to reach a low, they're going to take it out just because they can. And we were talking about the overall call would be back down to the testing of the dip below the red line here, which is the zero line. Not a huge draw to that. For me, it's mostly right around in this range, in the 2600 range, right at the open here of these bars, because the wicks, those are carry throughs. It's when you've caught a bunch of people who are just like out of it, and then all of a sudden it's just gobbled right up. And those are liquidity events, not usually heavy traffic, so to speak. So we're looking at our reading. Orange caught between the cyan and red, well, as is steel now too, because it's dipped below, is always a continuation move. So continuing of what? Oh yeah, hey, down, go figure. So right at the 23, hit some support overnight. It's back, it's still down even in the after hours here. So NQ from a daily standpoint, we don't have the Morganacci retrace on this one, but if we put it on there, it's going to look pretty much identical to what we just looked at on the ES. No need to get crazy. I mean, all you have to do is look at that spread between your short-term, mid-term buyers, as well as long-term. It's a little worse here for the NQ. You can see that the ES or the S&P had the steel above and was coming back down. We never even crossed it. So it's been in, short, clean short from this crossover right here, which happened to be right at the same time that green crossed below red, which is pretty powerful in and of itself. You didn't get the dramatic algo shift because this one was a little bit more drawn out, fading. I mean, it began with the DOC spread from a very, deep area right here, and then it just progressed on the next bar the next day where you had the clarification both with the green below red as well as the steel below cyan. And that was our first shakeout below the yellow line right there, you see. Because you don't want to be shorting into rising shakeout. I think we had that discussion yesterday. It's always good to keep going over. So flight back into euro as the U.S. markets were fading. Not a whole shock there. Europe's got its own issues, but for somehow they're ignored because it bolsters the U.S. The real issue is the deficit, the ridiculous spending bill, the amount of drain that's going to be on capital, the rising rates for no particular cause other than you can, no justification based on inflation at all. So this is just an opportunity for the Fed to continue to squeeze the so-called Trump rally. And of course, that attracts activity right into bonds. So that was a huge stimulus for them because the reality is it's much safer. You forfeit that capital risk and you move yourself into a guaranteed minuscule return. And oil. Still at the peaks, that was a positive extreme we had on the brief one there. Cyan DOC is still below red, meaning it is still in buy configuration. More likely than not, it's got to wait for the ABM yellow to catch up. When you get that far away from it, we always seem to get mean reversion back to it. It doesn't usually stay separate from it for very long. We can see that in past moves where you get the big move up, it catches up, big move up, kind of stalls until it can catch up, and so on and so forth. But again, this is your only real sign of inflationary pressures is right here. You're not seeing it on the wage side. Until that happens on the wage side, it's still not going to be significant enough to impact anything. And gold still stuck. This is a very interesting play because the reality is it should be much higher than it is, but that isn't where price is at, and therefore it is where it should be at this particular point. Now, whether you call it manipulation, whatever, that's irrelevant. So I had to shrink the day quite a bit. I mean, it's impossible to see that data. So we had talked about our previous short points. There was a little bit of rally back into 50%. We could see that that was beginning a nice little DOC spread right there. So you can, well, let's go ahead and increase it now, because now that we've seen that the whole day was pretty ugly, we can just go through some of the components because it was really exciting. It's some really nice short signals. Huge dips, attempts at rallies. They were still in very weak shakeout configuration. Or shakeout spent most of its time at these very depressed levels. Now, there were a couple of opportunities at some of these bottom areas that presented low risk to the downside. You weren't looking for much more than the, a hit of the 23% or maybe a bonus to the 50%. If you were lucky. This one was a little bit more attractive because you obviously had a shakeout that was in decent range. It was inside the negative 13. You already had the beginnings of a trend move right there, and it actually produced the best results, but it also gave really an excellent marker point for DOC spread, which took place not at the red line, but the one right after it. Because again, you had rising shakeout right there, but it's a little easier to see what I'm doing. It's covered over, as well as you had flat brown at this. I call it gold. I know it may look brown, depends on your screen, I guess, but it's gold. And that led to a very nice precipitous move back to the zero. We detailed that on our Skype chat as well, and producing some really nice gains. There were a couple of decent buys that developed here. You had cyan move below red, but even earlier, a couple of them that were at the bottoms on higher shakeout. Not the first one, but the second one, dip right here, was on the much higher level. Again, you could have played it to the 23% with your zero stop, so a very low exposure coming off the bottom of it. It's just a more aggressive. For most people, would I recommend it? Probably not. But if you're a scalper in that, you've got a clearly defined, stop point. You've got the improved shakeout, relatively speaking. One uptick move, and you're looking for at least a 1 to 2 zone move. In this case, took you to 50%, but then you had falling highs. If you took it early, if you waited until the cyan was below red, which is always a buy, or the shakeout just turned positive, take your pick. And falling highs draw to the upper portion of it, and sure enough, of course, the high fell so fast that it was a much less dramatic move, but needless to say, still a decent one. And you ended up with another DOC spread short setup, and one again at the end of the day that just kept on giving as we scroll across it. There we go. Nice broad range. And what was interesting about this was the confluence. We kept talking about this 2683. This goes back to the beginning of March, and a dip below the red line retrace set up from way back. So interesting that we kind of weight traded against it above, slightly below, back to it, and then it became some hard resistance. And just kind of fell under its own weight, and you can see just no closes here above the 23% until right over here, where the shakeout finally got healthy. And it's nice to see that when you look at that rose. I may make that a darker line just so it's more visible. I don't want to make it red because then it would be too dramatic, but maybe like a dark green or something like that makes it pop out a little bit more, given the red of the negative shakeout, just so you can grasp, because it's an important area, because you'll find repeatedly that unless it's a like delta V reversal, knee-jerk reaction, when you get this kind of depth, it's hard to come out of it in the brief. And a delta V reversal would be a large dramatic down move, kind of a wick bar that comes up, and then at least coming back 2/3 of that previous bar. That usually leads to a nice momentum play to the upside. So here we are right at the 50%, currently pre-market, about to get well over positive shakeout. So there's a good chance that we may even see this start to pull to the highs here as we get flat lows declining Morganacci. So it's pulling towards it. And, well, it's just the problem with this area is it just becomes a muck zone, and you don't have any resets of the steel. So fine, every time you get these steel cross back above cyan, at the same time you're getting green crossover of red, you've got a nice momentum play. That's going to happen no matter where it is in the zones. The difficulty is the sustainability of it, because you don't have those short-term buyers having been reset to where they have a full wad coming into action. So like you did back here where it came in and that produced after the short segment, you had a little bit more of a oomph. Now it wasn't a super clean. You like it when it gets down well below the 13.5, negative 13.5 number like this, but this is what happens in significant downturns. This is why it's one of those where you can kind of just follow the higher Fibonacci level, and then if you get a nice dip in the low, you can take it where you can see that there's going to be a little bit of a pop, and then you can short at the other area. Because I'm not a huge fan of following one massive long short or something like that, simply because you get become afraid or complacent in taking profits in that, and that's never a good place to be. So just thought I'd throw that one out there. As always, I'll keep posting charts as warranted. Trade well.